All right, so today we're going to break down IFRS S1. Now, this isn't just another set of sustainability rules. Think of it more as a new universal language for business, one that's all about building some serious trust with investors. Let's get into it.
Have you ever tried this? You pick up two sustainability reports from companies in the exact same industry, and it feels like you're comparing apples to, well, to aliens. For years, the data has been all over the place, making any kind of real, honest comparison pretty much impossible.
And that's exactly the problem IFRS S1 was built to solve. It's designed to cut right through all that confusion and get everyone on the same page, speaking the same language about sustainability.
So the best way to think about this isn't as a boring old rule book. Instead, picture it as a blueprint. It's a detailed plan that shows companies how to construct a sustainability report that's solid, reliable, and, most importantly, actually makes sense.
Okay, so every good blueprint starts with a strong foundation, right? In reporting, that foundation is all about quality, because without it, the whole report is pretty much worthless. So what does this foundation actually look like? Well, IFRS S1 says it's built on two core ideas.
First up, the information has to be relevant. And the test for that is super simple. Could this piece of information potentially make an investor change their mind, to buy, to sell, or to hold? If the answer is yes, it's relevant. If not, it's just noise. Second, the report needs to be a faithful representation of reality. What does that mean? It means you can't just cherry-pick the good stuff. The information has to be complete, totally neutral, so no bias, and accurate. Basically, you get the whole story, not just the polished, pretty version. Now, on top of that solid foundation, the blueprint adds 4 enhancers that turn good information into great information. Like, it has to be comparable. Can you easily track a company's water usage this year versus last year? It also has to be verifiable. Can an auditor come in and actually check the numbers? These qualities, plus being timely and understandable, are what really make the data useful. Okay, so we've got our high-quality building materials. The next part of our blueprint is about framing the structure itself. How do you decide which pieces of information actually get into the report to tell the story that matters? This is all guided by a principle called fair presentation. It's not just about ticking the required boxes. The standard says you have to disclose all the risks and opportunities that could affect your future. But it also says, hey, if just following the rules doesn't tell the whole story, you have to add more. So that apparel company might report all its required metrics, but also add details about switching to sustainable dyes, because investors know that's a huge sign of innovation and good risk management.
But look, you can't include everything, right? The report would be 1,000 pages long. So how do you filter it? The key concept here is materiality. Sound familiar? It's the same core idea as relevance. You have to ask, is this information so important that leaving it out or getting it wrong could actually sway an investor's decision? That's the final test.
So what does materiality look like in the real world? Sometimes it's about pure magnitude. For a car company recalling 500,000 vehicles, that's undeniably a big deal. The financial hit and the damage to the reputation is so massive, it absolutely has to be disclosed. That's material, no question. But materiality isn't always about one huge event. It can also be about the very nature of the issue itself. For an agricultural company, revealing that 30% of its cotton comes from uncertified sources, that's material. Why? Because for anyone investing in that industry, sustainable sourcing isn't just a nice-to-have, it's a critical signal about supply chain risk and brand value.
All right, so we have our foundation of quality, and we've framed out the important story. The final part of our blueprint is all about connecting the dots, making sure every part of the sustainability report lines up perfectly with the rest of the business.
First off, there's a simple, non-negotiable rule, the reporting entity. This just means the boundaries of the sustainability report have to perfectly match the boundaries of the financial statements. Whether it's one company or a whole group, the scope has to be identical, no exceptions.
Now this is where it gets really interesting, because the blueprint demands connected information. This is where the sustainability story has to physically link to the financial one. For example, if a company does a climate scenario analysis, that can't just be a theoretical exercise. It has to connect directly to things like asset impairment on the balance sheet. Or if they talk about improving fuel economy, that's linked to R&D spending. See? They're not separate stories. They're two sides of the very same coin. And that final connection is locked in with one last, simple rule of consistency: currency. Any dollar or euro or yen figure mentioned in the sustainability report has to be in the same currency as the financial statements. No confusion, no need to pull out a calculator.
So let's step back and look at the structure we've just built. We followed the blueprint, from the foundation of quality to the framing of what's material and all the way to connecting the final dots. And we've ended up with something pretty powerful. Because this is about way more than just a compliance report. When you apply all these principles together, you get a truly complete view of a company's value and its future. For an investor, it means they finally get a picture that is complete, consistent, and maybe for the first time, actually comparable to others. Look, we're moving into a world where sustainability performance is financial performance. The two are completely inseparable. So if that's the new language of business, then having a global standard like IFRS S1 isn't just a good idea, is it? It's the essential blueprint for building the one thing markets need to survive: trust.